Sofi Stock down around 10% today following their first quarter 2024 earnings. Regular viewers know that I've actually covered Sofi since around the time that it came public via SPAC. And I largely during this time period haven't been super constructive. If anything, I'd said the valuation just wasn't super compelling, that there were a lot of things that they needed to prove, before I'd get interested. But more recently, in the last few quarters, I've started becoming more constructive. Now, this view of overall conservatism, I think, has been proven, given the fact that since it's gone public, and certainly since it initially ramped up, the stock is down over 30%. So when, you saw those mega bulls saying, oh, this thing's going to the moon, and I was like, I don't know what you're talking about. They, no, that's no moon. Since then it's lost a lot of value, but now I'm starting to see some value increasingly accrue. And so it is getting my interest looking at SoFi, and it's not hard to see why. I mean, let's look at earnings insight. This is the latest tool from AI Ticker Chat. First month is free. Check out the link below for AI Ticker Chat, where Earnings Insight compares how they've done, how a company does versus the analyst estimates. As you can see in the most recent quarter, they beat on the revenue perspective, beating the average analyst estimate. Now, it was slightly higher. There was one high estimate that was higher, but we'll talk about that in a second. But broadly, looking at beats across the board for earnings over time. So I'm looking at a company that has a history of execution, and this is the part that really honestly turns me on with SoFi, is that they have a history of saying, we're going to do this, and they do even better. And relative to the universe of SPACs and most companies out there, when most companies say, hey, we want to do this, they usually come short. Even Tesla, for example, they'll say, hey, full self-driving and, later this year, and it doesn't happen. Whereas looking at SoFi, Anthony Noto, he says we're going to do this, and boom, meets or exceeds year after year after year. And you can see that going back to my initial videos on SoFi, the underlying fundamentals that they projected, they've beaten. And that's what I want to see. That's the type of management that I want to align with. And they continue to do it. In the most recent quarter, you can see that their guidance for the year is now in an uptick across the board versus what they were previously guiding to for 2024. So I like to see this. They're expecting 15 to 17% adjusted revenue growth, an improved earnings per share, which comes largely from a one-time benefit where they cleaned up their capital structure a bit in this past quarter, but increasingly positive earnings, which is what I want to see, and increasing tangible book value. And this is a key metric for investors to think about, is this growing at a reasonable or respectable clip over time? And just from a valuation perspective, I'll talk more about valuation towards the end of this video, but a lot of investors will look at companies like SoFi and they're curious, what's the underlying tangible value here? And that sort of creates a valuation in which value investors start getting interested. And so you right now know the tangible book value for SoFi is around $4 a share, just a little south of that. So that's the price where the deep value guys are going to start getting interested in. And just for context, Fairfax, which is an unrelated company, it's an insurance company. When I initially called it out to my subscribers before it went up over 100%, it was trading below book value. And when you have something trading around book value or below book value, when you see that and you believe that, wait a second, market's saying, below book value, not great, and you have a variant perception. As Michael Steinhardt would say, you believe that the underlying value of this business could actually increase over time. Then there's a mismatch between what market is pricing in and what you think the business could be worth. And so right now there is a premium for SoFi because, that tangible book value is around $4 versus, that stock price around $7. So there is a little bit of that premium, but it is, that premium I'd say is somewhat warranted. And we'll talk about that in just a second. Why is the stock selling off when you're beating expectations and you're continuing to grow and becoming increasingly profitable? What's going on here? So once again, I ask AI Ticker Chat. I'm checking in with the chat function to understand, why might the stock sell off following these results? And, it comes down to, so I'm selecting the earnings transcript. I'm selecting the press release using the most cutting edge model from OpenAI, the ChatGPT 4 Turbo. And it, honestly, the points that it answers, I think are very accurate. The stock following the potential reasons for a sell-off in SoFi stock, despite seemingly positive outcomes, like despite the positive earnings, might be due to several things, one of which is high expectations set by market analysts. And this gets to my point earlier that there was one analyst expecting a much higher revenue figure that they didn't hit. So maybe that's it. So they beat the average, but the highest estimate they didn't beat. Okay, so that's an interesting data point. Another aspect is future expectations. I think this is the key part of it here, which is that management provides guidance that is less optimistic, or there are signs of slowing growth in core areas. I don't think it's the less optimistic part because management's raising guidance, but the slowing growth in core areas such as loan origination, that is one that we're going to talk about in a second, or the macroeconomic factors. Could you have an economic downturn? That's been one of the concerns that I've had, thinking about SoFi for some time, which is that, it's one thing to grow very quickly. Part of the business model for a bank is, hey, just offer competitive deposits and then your balance sheet will just grow very quickly. But then can you invest that cash, the cash inflow from the deposits, can you invest that in a sound and secure way that you're making a nice spread? And can you do that throughout a full economic cycle? And that's the tougher part, where let's see how they're doing. But this is an example of why I'm becoming increasingly constructive, more favorable towards SoFi, is reading and hearing what management has to say, because they seem increasingly conservative and aware of where we are in terms of macroeconomics, and thinking about how they want to sort of lean into the economic turns that might be ahead. So here are two comments that I think are very interesting. As we shared last quarter, we've taken a more conservative approach toward originations, that's loan originations, given our concerns around rate uncertainty and the broader macro climate. So clearly the macro climate is something they're concerned about. They also don't want to be caught, in a position where if interest rates surge higher, that they're in a bad position. I've talked about several companies that have done that effectively, like Schwab. You can see that video. So they talk about how adjusted net revenue was flat year over year. Personal loan origination growth slowed to 11%. So origination for personal loans slowing significantly. And that's more in line with our conservative approach, because personal loans, that's much higher risk type of loan versus something where where the loan's backed by very tangible collateral. And we'll talk about that. I'll show you in a table later in this video. So in fact, the balance of personal loans on our balance sheet actually declined 2% quarter over quarter. So this does reflect management is trying to position themselves in a conservative way, taking a little bit of risk off the table. They answered further, because this obviously got some investors wondering, sort of what's going on. And they talk about, look, last year there was a banking crisis. We're concerned about others not being able to manage liquidity issues. They seem to be doing fairly well. Most banks, one of the asset tests I run is what's the equity total of the total assets, because that tells you how much assets could decline before you're in trouble. In the case with SoFi, what you're looking at is equity to assets of around 17-18%. That's what I like to see. So what you're effectively saying is assets would need to fall a lot before you really got into a trouble where you're like, oh, this is impaired. This isn't a fundamental problem. I've called out banks before. As a matter of fact, I did a video on Silicon Valley Bank within 24 hours of it, effectively going out of business, where I said, look, I don't see how this is not impaired. You can check that video out yourself if you're interested. So looking at them, it seems like management is conservatively running this business. They talk about how we sold $1.9 billion of loans in this quarter. I believe that's personal loans. That demand remains strong for personal loans. The environment remains sort of stable and more predictable. Could we be more aggressive in the lending business? 100%. We have the capital. We have the go-to-market strategy. This, I believe, they could easily double, let's say, their personal loan book if they wanted to. But I think they're being conservative here. Then they talk about we're just taking a very conservative view to make sure we don't go into an environment that we're completely unprepared for. So they're thinking about the economic environment, and they want to make sure that they are prepared in case there's either an economic downturn or interest rates spike higher. It's possible you could have both scenarios. Taking a conservative stance gives us the most optionality to do work. So I like to see this attitude, how they're running this business. And honestly, it's an attitude of a company where management is an owner. These are management operated, this is owner operated type of business. You could see most recently, Anthony Noto, he's the CEO of SoFi. He bought, a significant amount. He's been buying SoFi stock repeatedly last year, around $650 per share. And when you look at it, the underlying shares he owns, I mean, you're talking about tens of millions of dollars in SoFi stock. So this is what I want to see. I want to see skin in the game from management. Okay, so where does SoFi stock go from here? First of all, full disclosure, not financial advice. I don't own any SoFi shares at this time. That might change, though. I'm going to share more thoughts with my Unrivaled Investing subscribers in our exclusive Discord. And just last week, Woods, a premium member of the Unrivaled Investing community, shared the following. This is a direct quote. Prior to Unrivaled Investing, I was yielding around average or below average market returns. Post-membership, I've tripled my investing returns and have crushed a market with much lower risk. Thank you, Daniel, for your insights and your approach to investing. It has helped me improve my investing mindsets and returns. I'm currently ahead of my investing goals to retire at age 45. That is very kind praise from one member of the Unrivaled Investing community. By the way, I do expect to raise pricing for the premium membership at the end of next month. So now is the time to lock it in if you're interested. My approach is not to offer the occasional discount, but to every year to consider raising prices because I believe it's currently priced at or below market rates, especially for the premium offering. So looking at SoFi, looking at this underlying business, this is a business where they are winning. They are taking market share. You're seeing strong year-over-year growth, and you're seeing strong new member growth. Hundreds of thousands of people are signing up, millions of customers, joining the SoFi platform. And they're investing a lot to, expand their offering. And, for example, one part in the call, they mentioned how, look, we're losing like $100 million investing in, let's say, our credit card driven offerings and some of our specific offerings, but clearly this is a growth trajectory for them. So even though they're net profitable right now, there are some specific parts of this business where they're thinking long-term, multi-year perspective, and they're investing hundreds of millions of dollars right now. So that's what I like to see. I like to see the skin in the game, investing for the long term. But when you look at this business and you're sizing it up, look at this is a summary effectively from the income statement. $620 million from loans and securitizations, interest income. Deposit costs, interest expense has tripled from $73 million to $210 million. So what you're seeing here immediately is that this is an interest income business. This is a business driven by loans. Yes, a lot of people have talked about, this is the AWS for fintech, Galileo, it's going to take over the world. Look, $85 million in revenue versus $620 million for the interest income from loans and securitization. So this is really, it's a loan book at this time. They do have a technology company that is empowering other companies, but that is much smaller relative to their loan book. Maybe this does, continue to grow and, excel over time, things to watch. But it is important when you're thinking about SoFi to think of it as a bank, as sort of a bank plus. I would think about it. Now, sort of the leading indicators of what are they investing in is origination volumes. And I mentioned this earlier in this video. And you can see personal loans, 11% growth. That's a strong deceleration from where they previously were in the last few years. You can see the average loan balance is also shrinking slightly. But they are seeing growth and driving growth. Keep in mind, this is a choice that management has, saying, hey, what's the market? Where do we want to effectively make their investments? And they're saying we would rather invest in home loans where you have the underlying collateral sort of backing it up, a more safe loan. So that's where they're going gangbusters, 270% growth. So I think on each of these, if they wanted to just press the pedal to the accelerator, they could. They easily could. That's what management's saying. But I think they're being cautious here. They're saying, okay, let's think about the risk profiles that we want to have. Let's think about, where the economy is, and let's just be prudent about that. So overall, I like what I'm seeing. The question is, well, what do I think about the stock in terms of valuation? High level, this is a hypothetical valuation framework, by the way. The stock price can go way higher, way lower. When I look at it now, I think there's a lot of uncertainty with the underlying business because, you haven't achieved, let's say, 15 to 25% profit margins. That said, there are indications from other banks that, let's say, operate in different geographies. I own, a leading fintech bank that's not in the US, but has margins that are, much higher than this or comparable to this and expanding rapidly, and they're growing faster. And so I do see the path for them to get to, let's say, 15 to 25% profit margins over time. They're currently closer to single digits. So this is something to think about. Maybe there's even an element of conservative valuation here. But I think when looking at SoFi, that if they execute and they prove out their margins over time and they nail, let's say, this economic cycle, that you have hundreds of percent upside potential, depending on the execution, depending on market sentiment, sort of waking up and sort of saying, hey, this is more and more a conservatively run bank that's actually, making intelligent investments. So that the question is, let's see them prove that out. Let's make sure that in an economic recession, that personal loan book doesn't implode. Let's see that play out. And so that's sort of the camp that I'm in, where I want to see that, how do you do through that full cycle? And if your, loan delinquencies doesn't dramatically, skyrocket with higher unemployment, and, you're able to actually remain profitable through an economic downturn, then I would say that becomes increasingly interesting. So I look at this and I think SoFi broadly has a fair valuation, given where fair to potentially cheap based on what they could do. But there's a lot of uncertainty around, how the loan originations that they've done in the past, will they hold up? That personal loan book, billions of dollars personal loans, will that hold up in that economic downturn? Now, that's something that management's, they talk about various different elements, like, hey, we, our loan origination, the credit score of like 750 and above. So they're talking about strong credit in a downturn. Usually even the higher, credit tiers get pinched too. So that's the aspect that I'm mindful of. I personally don't own any SoFi yet, but I am becoming increasingly constructive on it, where I could see a situation where it's up several 100%, let's say over the next 5 years. And that's sort of what that framework was trying to suggest, which is that maybe you get a premium valuation multiple, continued execution, margin expansion. So we'll see. If they don't execute, and let's say, they start reporting losses again, then I'd say you have to throw out this hypothetical framework, and it's the downside. Then people start thinking about, okay, what's your tangible value, and that it starts turning into a dance around that price, closer to $3 to $4 a share. So this gives you that perspective. But an investor, just if you were to just think about this from, let's say, an odds or payout perspective, in one situation you're saying maybe a couple 100% upside, 2-3x, maybe more. Another, you're saying, hey, maybe it loses 50%, the betting formulas would say, hey, that would be enticing if you really believe that those two situations are even odds. Personally, I'm actually more inclined to believe that, management is probably playing this conservatively, so that they want to make sure they survive through whatever challenges there are, and they can get to that multi-100% upside over time. So I'm very curious to continue watching them execute, and I'll be watching, and I'd love to hear your comments below. If you have any thoughts, I'll definitely be sharing some thoughts in our exclusive community at unraveledinvesting.com. And if this video has been helpful for you, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for tuning in.